Hi there. This is the E.M.I for the month of September. Question number 1. How important is the US for India on the trade front? Question number 2. Can India shift some of its exports to China and Russia from the US? Question number 3. Is software a major driver of India's services exports? And how much does US contribute to it? Question number 4. Outside of trade, what do the numbers tell us about India-US relations? The United States is the most meaningful partner in trade for India. Amidst the US-India trade and tariff tensions, a peculiar question was heard in the market narratives. Can India shift its US exports to China and Russia? Now, before one gets to answer that question, we need to examine country rankings based on total trade, meaning exports plus imports, and where US ranks in that. US ranks number 1 on total trade, followed by China. US and China are like chalk and cheese. Trade with the US gives India the largest trade surplus, while trade with China gives India the largest trade deficit. After India's $40 billion plus trade surplus with the US, Netherlands around 7 billion and UK around 5 billion comes next in the order of India's trade surplus magnitude. Now, given the increasing risks around India's exports to the US, a logical question that follows is if India can shift its exports from the US to other countries. Now, the answer to that question is much more complicated than perceived and lies in a lot of variables, including politics, strategy, cost competitiveness, scale, etc. However, one can attempt to answer this question based on what other countries import from the world and also what the US imports from China. Can India step up and export more goods to China and Russia? Let's answer that question. Of the $3.3 trillion of US imports from the world, less than 3% of imports come from India. Within key segments, we can see that pharma imports from India account for nearly 6% of US's total pharma imports, and electrical imports from India account for around 3% of US's total electrical imports. Let's move to China. China's imports from India stand at 0.7% of its total imports from the world, much lower than the United States. And within segments, China imports 1.4% of its ore imports from India. Let's move to Russia. Russia's imports from India stand at 2.1% of its total imports from the world. It imports 4.7% of its pharma imports from India and 3.1% of its electrical imports from India. Can India export more to these countries? Let's take a broader look again. China's world imports are largely electrical imports, high-tech, followed by energy, soybean, and automobiles. These are all areas where India currently does not have much to offer in value and, more importantly, scale. Russia's world imports are different. They focus on importing manufacturing machinery, defense machinery, branded automobiles, electrical machinery, and pharmaceuticals. These are areas where there is little scope, but fairly limited. Okay, is there an opportunity in India's exporting to the US, given the tensions between US and China? Now, this is basically China plus one. US's imports from China, they are skewed towards telecom, manufacturing, construction equipment, and consumer apparel, where there appears to be some scope, but provided tariffs ease. Remember, currently at 50% tariffs, India is much less competitive than its Asian peers when compared to the first round of tariffs in April this year. In short, India's export composition of energy, relatively low-end autos, pharma, and smartphones do not match much with Chinese and Russian imports. Political probabilities apart, it seems reasonable to deduce that deeper US India trade relations would be much more realistic an outcome than deeper China Russia trade relations. US accounts for 54% of software exports, the largest driver of India's services. Of India's $388 billion services exports in FY25, software, IT and ITES included, accounted for well above $200 billion, of which more than $100 billion was just to the United States. 54% of India's software exports go to the United States. Let's take a quick slice of what India's services exports pie look like. Computer services at just under 50% of services exports. Then comes 20% from professional and management consulting. While some of this is ITES, this largely is towards strategic planning, technology consulting, financial consulting, etc. Transport, largely sea transport, and travel, including credit card settlements, these two account for the next largest segments of services exports. We saw that 54% of India's software exports was to the United States. It would be interesting to note that even for the United States software imports, India is a large share at around 50%. In other words, as US imports nearly 50% of its total software services imports from India, it therefore seems reasonable to expect that US might not impose heavy tariffs on India. However, the recent H1B episode has questioned this very assumption, and markets are now in a mode where they prefer not ruling out any possibility in entirety. Everything is a possibility for the markets now. India's services can be seen as important because while it has a low-cost structure, there are not many large countries with as skilled an IT workforce where US could shift its India IT imports to. India is also quite key for US companies who dominate the Indian technology landscape. It was very interesting for us to find that 7 large US companies in India, Apple, IBM, Amazon, Microsoft, Google, Meta, Netflix, all of these generate nearly $20 billion in India revenues in a year. And with such large interdependencies, the way ahead in the near term appears fairly obvious. The way ahead points towards finding a common ground. How important is the US for India? And what is the way out for India? US is the largest and most meaningful trade partner for India for both goods and services. Even outside of trade, US ties remain fairly important for India. Gross remittances inflow into India for FY25 was recorded at $135 billion, and US was the largest contributor at well above 25%, at $37.5 billion of gross remittances. Gross India equity FDI inflows stood at $50 billion in FY25, with Singapore, Mauritius seen as the top two countries, followed by United States. Now remember that Singapore and Mauritius are low tax jurisdictions and tax havens that are broadly used to channelize the flow of investments into India. They are not normally the source country of large investments. Studies suggest that around 30% of the FDI money flowing through these geographies into India acknowledge the United States as the source country. So if we adjust the FDI flows from Singapore and Mauritius accordingly, we see that the US is not just the largest remittance provider, but is also the largest FDI provider for India, with also more than 25% contribution. One must remember here that India and the US have had 5 successful rounds of negotiations before they had broken down. They've restarted again. While it is near impossible to decipher what led to a sudden shift in the US's attitude, one can safely pin the reason down to US's geopolitical considerations. How would this end then? Now, there are two broad possibilities. Firstly, India can behave like how China did with its Phase 1 deal during the last Republican presidency. How? India can wait it out till the tide turns in India's favor, which could either be successful negotiations or a result of a shift in US's current political dispensation. The second, which is more likely, is India negotiating a much lower tariff structure and accepting more competition in key sectors that are not politically sensitive. That's it from us for the moment. Till next time, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.